Are you new to the 401k world? You need to brush up with your qualified plan terms? You simply just interested in learning a little bit more about the terms that are involved in the 401k plans? Well, if so, this video is for you. If not, move on because we're just going over glossaries, etc. Anyway, this video will outline all the main terms one needs to know about qualified plans and the specifics around them. Kenner French with VastSolutionsGroup.com. We do tax, finance, and artificial intelligence for entrepreneurs. For over 50 years, we've been helping entrepreneurs to, one, lower taxes and two, get prepared for retirement. Specifically, we administer over 200 qualified plans, so we know a thing or two about that world. Please don't forget to like and subscribe to this video. We'd love to keep you as a friend. The first one, let's go over it. The 401k plan. In this type of defined contribution plan, the employee can contribute from the paycheck before taxes are taken out. The contributions go into what's called the 401k account, with the employee often choosing the investments based on options provided under the plan. In some plans, the employer also contributes, matching the employee's contribution up to a certain percentage. Simple and safe harbor 401k plans have additional employer contributions and vesting requirements. An automatic enrollment. Employers can automatically enroll employees in such a plan as a 401k plan or simple plan and place contributions deducted from an employee's paycheck into certain predetermined investments unless the employees decide otherwise. Participants can opt out of participation and have periodic opportunities to change their mind, etc., depending on the circumstance. It's completely up to them. Benefit accrual. That's the amount of benefits accumulated under the plan. Things called the cash balance plan, gaining popularity nowadays, a type of defined benefit plan that includes some elements that are similar to defined contribution plans because the benefit amount is computed on the formula using a contribution and earnings credit, and each participant has a hypothetical account value. Cash balance plans are more likely than traditional defined benefit plans to make lump sum distributions. If you have any questions, please call the office. Those are gaining more and more popularity. Defined benefit plans, I mentioned that earlier. This type of plan, also known as a traditional pension, it promises the participant a specified monthly benefit at retirement. The benefit often is based on factors such as your salary, your age, and the number of years that an employee worked for the employer. Defined contribution plan, in a DC plan as it's called, the employee and or the employer contributes to the employee's individual plan account. The employee often decides how much the account is in there. The value of the account will change based on the value and performance of the investments going up and down. The amount in the account at distribution includes the contributions and investment gains and losses minus any administrative fees. The contributions and earnings are not taken until distribution. Employee Retirement Income Security Act, or ERISA, a federal law that set the standard for protection of individuals in most plans, private sector plans, etc. Requires plans to provide plan information to participants such as, plan features, funding, minimum requirements, vesting, benefit, accruals, etc., etc. It provides fiduciary responsibilities, by the way, for those who manage and control plan assets and requires plans to establish a claims and appeals process to make sure participants are taken care of. An employee stock ownership plan, or ESOP, it's a type of defined contribution plan that is invested primarily in employer stock. Now, let's go over an individual benefit statement. It's the statement in which you can see as an employee or a participant your vesting, your account balance. You get that on a periodic basis depending on the circumstances. If you have any questions about those, because sometimes we get a number of questions about IBS and benefit statements, please call the office. Individual retirement account, or IRA, an individual account which is set up at a financial institution such as a bank or a mutual fund company, sometimes insurance company. Under federal law, individuals may set aside personal savings up to a certain amount and the investments grow tax deferred. In addition, defined contribution plan participants can transfer money from an employer retirement plan to an IRA when leaving that employer. IRAs can be part of an employer plan, by the way. Money purchase plans, not that popular nowadays, but a money purchase plan requires a set annual contribution from the employer to individual accounts, and it's subject to other specific rules. Multi-employer plans. A retirement plan that's sponsored by several employees under a collective bargaining agreement that meets certain other requirements. A participant who changes jobs from one plan sponsor under this arrangement can do it and stay in the same plan. A plan administrator is the person identified in the plan document as having responsibility for running the plan. It could be, let's say, an employer, it could be a committee of employees, a company executive, or someone hired for that purpose, any of the above. A plan document, a written instrument under which the plan is established and operated. A plan fiduciary is anyone who exercises discretionary authority over the plan assets or has control of the plan. Also exercises any authority over the investment management and disposition of plan assets or gives investment advice about plan assets for a fee other than compensation. Plan trustee. Someone who has the exclusive authority and discretion to manage and control the assets of the plan. The trustee can be subject to the direction of a named fiduciary, and the named fiduciary can appoint one or more investment managers for the plan's assets. A plan year. Plan year is a 12-month period designated by a retirement plan for calculating vesting and distribution, among other things. The plan year can be a calendar year or an alternative period, July 1st, let's say, to June 30th, depending on the circumstance. A profit sharing plan. A profit sharing plan allows the employer each year to determine how much to contribute to the plan out of the profits of the company, etc., in cash or employer stock. The plan contains a formula for allocating the annual contribution among its participants. A rollover. A lot of people like this. A rollover occurs when a participant leaves an employer and directs the DC plan, defined contribution plan, to transfer the money in the account to the new plan or individual retirement account. This preserves the benefits and does not trigger any tax consequences, so it's tax neutral, if done in a timely manner. A safe harbor 401k plan. What is that? You've probably heard that, right? It's similar to a traditional 401k plan, but the employer is required to make contributions for each employee. The employer contributions in the safe harbor 401k, it's immediately vested. A safe harbor 401k eases administrative burdens on employers by eliminating some of the complex rules which sometimes confuse people. Savings incentive match plan for employees of small employers or simple plan. It's a plan in which a small business with 100 or fewer employees can offer retirement benefits through employee salary reductions and matching contributions, quite similar to a 401k plan. Simple IRA plans impose few administrative burdens on employers because employees own the IRA and the bank or financial institution receiving the funds does most of the paperwork. While each has some different features, including contribution limits and the availability of loans required in employer contributions, they're automatically 100% vested in both. Simplified employee pension or SEP plan. It's a plan in which the employer makes contributions on a tax-favored basis to employee-owned individual accounts, or IRAs. If certain conditions are met, the employer is not subject to the reporting and disclosure requirements of most retirement plans. Under a SEP, an IRA is set up by or for an employee to accept the employer's contribution. A summary plan description, or SPD. It's a document provided by the plan administrator that includes a plain language description of important features of the plan, such as when an employee begins to participate in the plan, how service and benefits are calculated, when benefits become vested, when and how payment is received, and how to file a claim for benefits. Participants must be informed of material changes either through the SPD or in a separate document called Summary of Material Modifications, or SMM. Vested benefits. People love hearing their vested benefits. Those are benefits that the individual has earned a right to receive and cannot be forfeited. Years of service. The time an individual has worked in a specific job covered by the plan. It is used to determine when an individual can participate and vest and how they can accrue benefits in the plan. Now, please do not think of this as an exhaustive list. It's just an overview. For others, if you have any questions or any concerns or need more information about some of these glossary items, check us out on the web at www.vastsolutionsgroup.com or give us a call at 888-808-8278. Hopefully this has been of value. It's a little technical, but some of these terms are vital for understanding 401k plans. Now, please remember, subscribe. We'd love it if we had more friends out there. Plus, please like this video. Hopefully it's, once again, been of value. My name is Kenner French, signing off.